You know, there's this incredibly powerful force reshaping the stock market, kind of like a hidden engine that can drive these massive swings in just a matter of hours. They're called zero-day to expiration options, or zero DTEs for short. So in this explainer, we're going to break down exactly what they are and why their explosive growth has, well, it's fundamentally changed the game for everyone.
Have you ever noticed that? How the markets can be totally calm for hours and then just erupt in a frenzy of activity late in the afternoon? Or how they can swing like crazy right around a big data release? Well, you're not imagining things. A huge part of the answer lies with zero DTEs, and we're about to dive into exactly why.
All right, here's our game plan. First, we'll get into what these things are and just how big they become. Then we'll dig into the mechanics, the engine room really, that lets them either amplify or absorb market shocks. We're also going to bust some common myths about who's trading them, look at the smart strategies versus the extreme risks, and finally, we'll take a peek into the future to see where this is all headed.
Okay, so what exactly are we talking about here? Simply put, zero DTEs are options that are bought and sold on the very same day they expire. I mean, think about that. It compresses the entire life of a trade, all the risk, the hedging, the profit or loss, into just a few hours. It's basically the financial market on hyperspeed.
And the scale here, it is just staggering. Seriously, this isn't some tiny niche product tucked away in a corner anymore. By 2025, zero DTEs were making up almost 60% of all options trading on the S&P 500. They've gone from the absolute fringe to being a core central part of the US market.
And just look at this growth curve. It's wild. Back in 2016, zero DTEs were just a tiny sliver, maybe 5% of the S&P 500 options market. Fast forward to mid-2023, and boom, they're half the market. By 2025, they're the dominant force, with daily trading volumes hitting insane new records. We are talking about a truly seismic shift in how the market works, day in and day out.
So you've got to be asking, how can these super short-term things have such a massive effect? Well, the answer lies in this really powerful, kind of wonky concept called gamma. You can think of it as the market's hidden volatility engine.
Okay, so stick with me. Here's the key idea. Every option has a sensitivity to the market's direction. What gamma measures is how fast that sensitivity changes. And with zero DTEs, the clock is ticking down to zero, so gamma gets incredibly high. The sports car analogy is just perfect. You're flying down the highway, and a tiny twitch of the steering wheel can make the car swerve dramatically. It's the same in the market. A small price move can force the big dealers to make huge, sudden trades just to manage their risk.
Now, this whole thing creates two totally different market environments. On one side, dealers can be long gamma. When this happens, their hedging acts like a shock absorber for the market. They sell when the market goes up, and they buy when it goes down. It really dampens the swings. But, on the other side, they can be short gamma. Now they're forced to do the exact opposite. They have to buy into rallies and sell into sell-offs. This is what we call pro-cyclical, and it's like pouring gasoline on a fire. It just amplifies every single move.
All right, so there's this popular story out there that zero DTEs are just a speculative craze, driven by retail traders basically gambling their money away. But when you actually look at the data, the reality, it's a bit more complicated than that.
And yeah, this breakdown is pretty surprising. I mean, sure, retail traders make up just over half the volume. But look at that. Big institutions are right there with them, at 47%. This is not just a retail story. The so-called smart money is a huge, huge part of this market.
And this is such a critical point. A massive headline number, millions of contracts traded, doesn't automatically mean the market is about to blow up. If the buying and selling are pretty balanced, the net risk for the dealers can actually be quite small. The market stability doesn't depend on the raw volume, but on whether all that trading suddenly becomes dangerously one-sided.
So this brings us to the real dual nature of these products. For the sophisticated pros, they can be incredibly precise tools. But for anyone who's unprepared, they are just loaded with extreme, fast-moving risks. So what are the legitimate ways to use these? Well, think of it in two ways. First, as single-day insurance. Let's say a portfolio manager is worried about a big Fed announcement in the afternoon. They can buy a zero DTE option to protect their portfolio for just those few hours. It's like disposable protection. Second, as a surgical bet. A trader can use them to make a very specific wager on market volatility over the next, say, 2 hours, all while knowing exactly what their maximum risk is. But the other side of that coin is just immense risk. That gamma we talked about can explode,
totally changing your position's risk in minutes. Liquidity can just vanish, turning a small paper loss into a catastrophic real one. And probably the biggest danger of all is for people who sell naked options. That's selling an option without owning the stock. In that case, your potential losses are, and I mean this literally, unlimited. Your broker could be forced to liquidate your entire position at the absolute worst possible moment. You know, this warning from FINRA about leveraged ETFs, it is so incredibly relevant here, because zero DTEs are the ultimate one trading session product. The regulator's big concern is that these products, designed for daily research, can behave in ways that are just disastrous for investors who don't really get the weird math of daily compounding and decay.
Exactly. This volatility decay thing means these instruments are mathematically designed to lose value over time, especially in choppy markets. So let me put it really simply. They can be powerful trading tools, but they are absolutely not long-term investments.
So where does all this go from here? The most important question isn't whether zero DTEs are going to grow to 65% of index volume or something. No, the real evolution, the next big step, is happening somewhere else entirely. The next frontier is taking this whole concept from broad market indices like the S&P 500 and applying it to individual, huge, single stocks. And this move, well, it fundamentally changes the entire risk equation.
And listen, this isn't just a theory, it's already happening. Exchanges have already given the green light for daily expiries on some of the biggest, most heavily traded stocks in the world. And here's the crucial difference. An index, like the S&P, diversifies risk across hundreds of companies. A single stock concentrates all of that risk. An earnings shock, a bad news headline, it can cause a much more violent price gap, which could interact in some really dangerous ways with these high gamma hedging flows we've been talking about.
So all of this leaves us with a really critical question. Does zero DTEs represent some new, hyper-efficient way to manage risk and express your views in real time? Or have we accidentally created this complex feedback loop where the market's own hedging mechanisms can become the primary source of its instability? The answer is probably a bit of both, and figuring out that balance is now absolutely essential for pretty much everyone in the market.